and welcome to another live episode of The Yield. Be sure to subscribe to the show on Apple Podcasts, Spotify, or YouTube, and leave a review if you're enjoying the content. In case we haven't met before, I'm your host, Peter Kerr. I'm the Director of Product Marketing here at Yieldstreet. And today I'm joined by Daniel Eberhard, who is an entrepreneur who co-founded and sold a wind energy company and has since founded KOHO, the leading Canadian challenger bank. Daniel, welcome to the show.
Thank you so much for having me. Excited to be here.
Of course. I got to first, of course, make mention. You kind of stole my style here with the black glasses. So I hope you know it doesn't go unnoticed.
I think it's like a kit that you send away for when you're in the tech world, you know?
Yeah, and unfortunately, I broke my other pair. So I think we're going to go two dark shaded glasses for today.
Sure.
But perhaps maybe to start off, you could introduce yourself and kind of give everyone a good sense of your background and sort of what you've done so far in your career.
Yeah, sure. So as you kind of mentioned, co-founded a wind energy company out of university. That was analogous to folks that are familiar with Solar City, but sort of a smaller, obviously, Solar City for wind. And it was building kind of micro wind turbines, selling them privately to farmers all over central Canada. Through that process, got into industrial scale wind farm development and ended up kind of building a couple wind farms. And then that was subsequently acquired. And like a lot of folks, whenever you have an exit, there's a big chunk of luck that goes into that. And then we ended up getting back into the renewable energy for one more try on. I don't know if I don't know if you've ever seen the photos of like flare gas at night, but it's just an interesting thing to Google at some point. But we were trying to capture that flare gas, which is a waste product of the fracking process. And that one didn't work. And we spent kind of a year on it. And then the kind of market dynamics changed and the political dynamics changed and that the economics no longer worked. And so that was like a pretty good, hard lesson for me to kind of like operate more in markets that I felt like were meritocracies. And then I moved into what is now KOHO. So KOHO is what's known as a challenger bank. It means technology enabled leader in the space in terms of how do we and trying to do two things. How do we give everybody a great financial foundation? How do we democratize access to the best financial products? Launched in 2017, have raised about 130 million and the leader in the space in Canada, and but still feels very early and learning new things every day. So that's a bit about me.
Well, that's great. And I have to ask, so KOHO, I mean, is that based on the Canadian hockey company as far as the genesis of the name?
Yeah, no, it's a so the short answer is no. So maybe it is, but it's opportunistic. So I wanted something that was short and phonetically simple. But then, so KOHO was as you say, a hockey equipment company, and then that company was acquired by Reebok and then kind of shelved. And folks that, if you remember, when you type something in Google and you misspell it, it auto corrects your word to what you think it is. To what Google thinks it is. Now, in the case of KOHO, there was sufficient search history that didn't happen, but there was also no SEO competition. So it was like a very mercenary decision about hijacking SEO juice on day one, that put us on the path of KOHO, and it just ticked the other boxes. So
that's actually incredibly interesting, especially when you think about how kind of SEO has really taken over how people think about positioning themselves in the public domain on the internet. It's certainly something that I think more than anything else, historically, when you go on Google, you don't realize just how much goes into each one of those results, especially from the companies who are trying to either, bid for the advertisement space or even those that are trying to do it maybe more organically.
Totally. Yeah. I mean, today we get 35% of our customers organically, not necessarily because of that, obviously, but it is like a huge downward pressure on our cost to acquire and those kind of things. So it's important for sure.
Yeah, so in your intro, you kind of mentioned challenger bank, and I think it's kind of becoming a little bit of a little bit of a trending word. I guess you think about certain areas where innovation is really happening. A lot of them are, I would say, lack of anything else, a little bit disruptive, but also really trying to pioneer kind of a new space. It seems like often with the challenger banks, they're really actually trying to attack the incumbents, right? The largest financial institutions in the world. Why do you think that is, as opposed to maybe some other areas where you kind of shy away from maybe going after the incumbents and trying to create at least your own path in a certain sense?
Yeah, I mean, I think it's a couple things, right? The first thing is like the the thing that makes it hard is also the thing that makes it very valuable, right? And so if you can participate in that market share that the incumbents have historically had, that's a really great outcome. I think people often kind of frame it as us versus the incumbents. I don't think that's true. Like, banking is not zero sum, and nor are markets. And so I think there's some folks that the challenger bank model benefits a lot, and I think there's certain other folks that can and should stay with banks because they're going to be better served there. I think that what is a natural outcome of the challenger bank model, which is typically folks who are heavy on tech and light on deposit taking and some of the hardcore banking, although that varies from model to model, is banks just have so much infrastructure associated with serving accounts. And so when it comes to especially lower and middle income folks, there's often like a lot of misalignment between the banks and those users, because the banks have this this need to make these accounts profitable, and very often that's a function of the cost structure and the operational infrastructure that they have to underwrite against these folks. And so challenger banks have the opportunity to massively reduce the cost structure, massively increase customer alignment, and I think that's a really good outcome for those users who typically are underserved.
Yeah, so to that point, I mean, when you say underserved, maybe we can start there first. You mentioned quite often banks are really best structured to deal with those with large deposit bases. Obviously, there's other products that they can sort of extend to them as well, and the overall customer becomes more profitable. Who are some of these underserved, individuals or groups that you guys are kind of thinking about?
I mean, so if we just think about the average Canadian or the average American, right? Overwhelmingly, these folks are living paycheck to paycheck. Overwhelmingly, they don't have more than $5,000 in deposits. And so, that there's a couple things that make that like a really difficult situation for these folks. So one is, and I'll just speak to Canada because that's obviously the market we're familiar with. So if you bank at one of the big institutions in Canada, which have a lot of regulatory protection to make sure that they stay that way, and you have less than $5,000, they're going to pay you usually 0.01, maybe 0.05% on a savings account. Now, 2/3 of Canadians have less than $5,000. It's also true of Americans. So in our mind, that's fairly synonymous with like a poor tax. If you with these institutions, which your parents banked with and you've grown up with, you're making 0.01%, that's going to get outpaced by inflation 200 to 1, or maybe 500 to 1 in these environments, right? And so that narrative is also true of where these folks overwhelmingly pay the majority of the bank fees is either low income folks or high income folks who are getting private banking. You could look at investor products and you could say most, probably 95% of investment portfolios should be relatively identical, which is around like a lower fee structure, especially for folks who don't have a lot of assets, which should optimize for like a lower fee structure and indexes. And so I started this company because my mom is one of those people who who didn't have a lot of money, and she was in all of these really expensive investment products, and that kind of didn't make sense, and so that sort of catalyzed me on the path to KOHO. So I think all of those things are opportunities for alignment and improved customer experience.
So maybe you could start off just by talking a little bit about KOHO, right? I think a lot of people probably initially thought that you were acting, at least primarily as a bank, but it seems though you guys offer other services as well. Maybe you could kind of walk us through some of those.
Yeah. So the areas that we're really focused on, so the way that KOHO works is we partner with a bank. The bank takes those deposits and we sit on top of that infrastructure and do kind of everything else. And so we do a couple things. The core product experience is predicated on obviously a better UX, no fees, and we give real-time cash back on every transaction. But then the products that we're super interested in are credit and payroll. And so on the credit side, we launched a product this year called Credit Builder. And one of the things we found in the market was the historical narrative around building credit was you go get a credit card. And if you have a bad credit score, or if you don't want to use a credit card, there's relatively little options. And then especially for folks who need credit, they end up in kind of the payday lending space. which is not a good space for anybody to be. And so we launched a credit building product. It's $7 a month, and it just like helps you build a credit profile and improve your credit score by like giving you nudges on the right behavior on a line of credit that we extend to you. So there's no debt. There's no like, I shouldn't say there's no debt. There's no like debt spirals. You just pay a $7 a month monthly fee, and we kind of automate a lot of this infrastructure for you. We also give folks a free advance on their payroll if they use us for direct deposit. So what we found was lots of folks are, when they are running out of money, it ends up being about an $80 bill on average. And so we will advance you $100 for free on KOHO if you use us for direct deposit. That's like the debt side. And then on the payroll side, we have things that let you earn. We have partnerships with payroll providers, and if you are one of the folks who are in this ecosystem, you can actually call up to 50% of your wages in advance, and you can do that on a daily basis if you want to. So especially for folks living paycheck to paycheck, waiting 2 weeks to get paid is super problematic and super expensive. And so we're trying to effectively attack that and bring the time between when you work to the time when you receive that benefit from like 2 weeks to daily. And then ultimately, like, you can imagine a future where that should be effectively real time.
Yeah, so you mentioned, obviously KOHO kind of sits on top of a lot of these financial institutions and banks, but I guess, the first question that comes to mind is, how are you guys not just layering fees on top of what the banks are already charging, or how do you guys kind of partner to reduce some of the other friction that's kind of inherent just with having a bank account?
Yeah, well, I mean, so first of all, I think the infrastructure is fundamentally different, right? We don't have branches. We don't have any of that kind of stuff. Like today, we have about 1,700 to 2,000 accounts per employee at KOHO, and the banks have about a ratio of about 1/10 that. So they're about 200 accounts to the employee. And our infrastructure theoretically should scale to 20,000 accounts, right? And so as you think about, whereas banks have to make a certain amount of money on these lower income users because it costs them so much to serve them, we don't have that pressure and that same kind of misalignment, purely as a function of like cost base. And that's not just like branches, but it's also our technical infrastructure is obviously much more advanced, cloud, multi-geo, that kind of stuff. And then the second thing is, the banks are really good at holding deposits securely, and we should absolutely use that. But there is lots of, that's kind of a commodity, right? And so we don't, taking and moving money is like a pretty low cost behavior, frankly. And then by building like some of these other features like credit building and stuff like that on top of it, we think that we can sell products to users or cross-sell products to users, but we think we can do so in just ways that are much more aligned with what a good outcome for a user is.
So essentially, do you guys aggregate all the deposits, essentially on your platform? Essentially, you act as a single account to the banks themselves?
Yeah, so that's a good insight. So yeah, like basically all these deposits sit ultimately with one of the major banks in Canada, and then you overlay a ledger on this account infrastructure, that says customer X has $70 and customer Y has $2,000, and you can just because of that, you have a lot less oversight. Not less oversight, you have a lot less infrastructure required versus like a 1-to-1 account ratio. You have a 1-to-many account ratio.
Yeah, that makes a lot of sense. So again, it seems as though a lot of these like incumbents within the space, as you mentioned, they've got all this legacy infrastructure. They're serving many different needs and maybe, a wide spectrum of clients for which their model doesn't fit all well. I guess my next question is just kind of around, how do you think those banks evolve, knowing that obviously there's a lot of other competition coming out there for some of those lower deposit customers?
Yeah, I mean, I think that's the key question to all of this, right? And I think at least we've seen in Canada, there is very different go-to-markets. I think some banks will build their own infrastructure, and we've seen like JP Morgan has built their own challenger bank called Marcus. The banks have got together and built a product called Zelle for payments, which is doing really well. So I think like banks will for sure respond. I guess that the nuance is there's two nuances. One, it certainly varies from bank to bank whether they want to do a build, partner, buy model, or perhaps they don't think this is a threat, which there's definitely those folks too. The other nuance is that these banks are not monoliths, and there is a lot of, if you think about a credit card department is measured every quarter in the public markets predicated on how much credit card debt and how much credit card fees it sells. And so there's a lot of inertia around the existing machine working at banks. And so, there's competing dynamics within these banks, and it's unclear to me which one will win out, but it's certainly good for customers if the market evolves and they get more competitive on some of these dimensions we're trying to win on.
Yeah. So assuming like, let's say that you guys, ultimately end up being extremely successful, right? And you continue to grow and scale. How do you see yourselves being different from the banks, let's say 10 to 15 years from now, assuming all else is well? Like you ultimately, again, get your banking charter, but, start handling deposits, again, in-house on your own. And then how do you guys kind of prevent yourselves from going public and starting to have some of those same metrics, maybe on behalf of the credit score that you guys are talking about?
Yeah, that's a wonderful question, right? And it is. And so I think so we have a couple heuristics internally. And so first it has to start with a fundamental belief that you can build a more profitable business by not having a short-term zero-sum relationship with your customers. And so that means, we believe that we can build what we call long-term positive sum, which is maybe bank speak, but like before we launch a product, one of the internal heuristics we get to measure ourselves to, which is very hard for a bank, is would we be proud to recommend this product to somebody we cared about? And we have a number of those kind of decisions in the way that we look at our credit revenue distribution and internally that we look at to say, like, are we proud of this? Is this a good product? And you have to create the incentive structures inside the organization to inoculate your organization from, optimizing for short-term profit maximization on a per customer basis, because we believe two things. One, these customers are going to grow with us for the next 30, 40, 50 years. And so like, that's the juice, that's the value of the business. And two, by competing for customers in this way, it is going to be very difficult for banks to compete on these same dimensions, because banks typically operate with each financial product being its own line item. It doesn't look at what other products you use. It doesn't subsidize based on other products that you use. And so there is a ton of inertia in this machine that's going to be really hard for banks to compete on.
Yeah. And then do you think, banks should start divesting from some of maybe their endeavors to kind of get slimmer, and kind of, again, maybe even move further up market and sort of shed some of those lower, I guess maybe the question is also, the Q&A one is also kind of like, a little bit along the lines of how banks, evolve to compete with you. And then also to that, how much do you think banks actually will find it to be an incentive to perhaps, no longer serve some of those lower deposit households, and sort of either partner with you and, or, again, eventually acquire you even to serve as a different proxy for that segment of the market?
Yeah, I mean, I think that's the case, right? Is some folks, some banks say, yeah, we'll never build the front end as good as KOHO can, and nor should we try. And those are banks that we want to partner with, because there's lots of stuff that they're really good at that we don't frankly want to be good at, and then so like it's important that we don't think about banks as a monolith. We think of them as a market, right? And there's, even though it's a fairly centralized market, they all have different points of view as a bank, and also within those banks about what they're going to do. And so there's what I would say is, I don't think banks are okay ceding market share. I think they are okay recognizing that they will not be competitive in this market without partnering, and then this is their wedge into participate with that market.
That makes a lot of sense. You spoke a little bit earlier on about your sort of credit score product, right? Hoping you can talk a little bit more about that and some of the pods that you do to help people improve their credit, and then also maybe before that, so you can just talk about what some of the most common pitfalls are for how people kind of end up maybe with a lower credit score maybe than what they should based on their own actions.
Sure. But I mean, look, I mean, I've had a bad credit score before and been denied credit cards, and I'm, financially quite solvent. And my own situation was, that I disagreed with a cell phone company about a bill that I should be charged. And it was like, I think there was merit to that. And as a result, like, of not wanting to pay it, they reported to the bureaus, and unless you're willing to put hours and hours into this stuff, you take your credit score takes it on the chin. And so eventually I caved. I think people arrive with bad credit scores for a variety of reasons. I think people arrive because they're new to the country, and they don't have a credit profile, which is called thin file. I think people arrive at credit scores because they're not good at paying their debts. Like they might be, sort of quote unquote financially irresponsible, or they might just be like financially vulnerable, where like a lot of folks, they live on every now and then they need credit, and you get a couple bad things that happen in a row to you, and that puts you into a bad credit situation. And so, I think people arrive at a variety of reasons, and like frankly, saying somebody has a 600 credit score, it's a fairly blunt read on, do they have a 600 credit score because they're new to the country, because they've missed their last 20 payments, or because they're like financially vulnerable and super exposed, right? And those mean really different things. And so the way that our credit score works is like we give you a line of credit, and then we automate the optimal withdrawal of that line of credit. So you can withdraw on all of it, or you can withdraw on 30%, or you can withdraw against zero. We recommend 30%. And so if the line of credit is $750, you'll withdraw $250, and then you'll pay that back at the end of the month. And that, to the credit score, to the credit bureau, reads like responsible credit behavior, which is, that you consistently withdraw, that you consistently utilize, and you consistently utilize about a third of that, and then you consistently pay it back. And this is behaviorally indicative of like people who have the right credit behavior such that their credit score should improve.
And so I'm curious to that, when you guys are taking on new clients, what level of credit score do you guys take into account? Obviously, you mentioned some different criteria and different nuances to each score, but is it open for all, or do you guys have a process on the front end to kind of screen through some new customers?
It's open for all, and so everybody can get credit building. One of the things that we find fascinating is, and one of kind of the hooks is, if you are borrowing a payday loan, the typical default rate on payday lending is like 15 to 20%, which is why they charge such egregious fees and usurious fees. Our default rate when folks use KOHO for direct deposit is like, it's much less than 1/10 of that, right? And so we have like, let's call it 10% of the default rate that payday lending does, just because we know when your paycheck's coming, and we know that you have a repetitive paycheck. So that allows us to lend money to folks much cheaper, as a function of the insight that we have into who these users are and how they're using KOHO and all that kind of stuff.
Do you sort of automate the process where you kind of interject yourself, from the deposit to the time when someone could actually, and again, assuming direct deposit in that instance, but before someone could actually get access to that paycheck?
So we do. And then the notionally what's happened is you're kind of graduating. Like nothing is a better indicator of your ability to repay credit than historical repayments of credit. Right. And so if you start small, you can keep your credit losses small, and then you can lend folks more and more over time. And so that's kind of the direction we're going with KOHO.
Very interesting. So, the other thing that kind of comes up, we've had a couple of guests come on throughout the course of the year, and certainly, banks as they currently exist are obviously at least perceived to be under some existential threat due to, blockchain, digital currencies, and the like. What, if anything, do you guys see as far as a threat for sort of how you guys currently operate, and what do you guys think kind of about digital currencies overall relative to how people are sort of normally operating?
So I think we're still super early in the digital currency market. I think it's still very much a tool of speculation, and an asset class that makes sense for lots of folks, some folks. But it's not really solving the problem yet that we care about, which is like day-to-day, everyday folks getting access to their money user earlier, getting better financial foundations, those kinds of things. That said, what is true of the banks, and that they have like largely a regulatory protectionist moat, and in some cases a monopolistic moat. It's certainly true in Canada, and to some degree in the United States. I'm a believer in markets, man. And so I think like the pressure that cryptocurrency is putting on the international banking system around speed of transaction, simplicity, transparency, fees, all these kinds of things, as a result, both outcomes will get to a better place. So people tend to frame a lot of these things as like binary, one or the other, and competing forces. I'm sure that in 30 years, we're still going to have banks and they'll probably look differently. And I'm sure in 30 years, we're going to have decentralized currency and it will probably look different. And so I think that these are like complementary forces from a market perspective that are both necessary to, like, frankly, keep the other side of the market honest.
Oh, very interesting. Certainly, like when we think like, again, certain cashless payments and the like, I think, people are very excited, but we always make the joke that most people feel with Zelle alone that they're already kind of doing a form of digital transfer. So it's certainly something that we always try to talk about.
One thing that I'll add is, like, I think it's very natural, but we tend to have a very like domestic focus on our with our intuitions on this kind of stuff, right? And so, to your point, like, you're mapping this to Zelle and stuff like, but if you're in Argentina, which has gone through hyperinflation 6 times in the last 100 years, well, like, theoretically, your savings are wiped out every 20 years in that country because of like inflation. And so, having like hedges or if you're in Africa, like, and you don't have banking infrastructure in the trust infrastructure that we have here, like, there's a much greater use case there to just accelerate those folks into a trust-based system. And so that, I think the applications vary country to country.
How do you feel then about the adoption in El Salvador just to actually allow Bitcoin as legal tender?
I think it's great. I think there's no, at scale, there's no reason why Bitcoin should not be a legal tender. Now, you can make the case that it should be a different currency because of, transaction costs and those kinds of things. But I think it's a massive, the market cap of Bitcoin is bigger than a lot of the GDPs of countries, and those are fiat accepted currencies. So, I mean, to me, it completely makes sense.
Yeah, no, it's great. So, one of the things you talked about up front, and you actually gave some great insight just as far as, some of the influences outside of your control in starting and running and operating a business, particularly on the political side, and, a topic as controversial at times as fracking and the energy space. But I'm kind of curious, you had one, coming out of university, you had one really successful startup. You obviously had a more challenging endeavor. What were kind of some of the things that you learned along the way, just kind of really becoming an entrepreneur? But obviously, I imagine you were riding high after your first success, and the next one just kind of gives you some new perspective and again, some different learnings.
Yeah, so I think my the first one. So the first one that, like, the big kind of thing for me is, I think, like a lot of folks, and maybe it was a function of age or what have you, but I kind of assumed that these big companies were like these impenetrable vehicles that were well run, and I just, like, very naive. And then I got up close to them, and there was an enormous amount of obvious room to improve the way that these entities ran. And, like, kind of anecdotally, when we were selling the wind energy company, nobody would call us. They should have outcompeted us if they put an associate and like an intern on this and, like, gave them the resources. There's no reason we should have won those contracts. And they didn't. They didn't have their eye on the ball, and as a result, like, we had a short list a year later of 9 of them trying to buy us. And so it was like, I think dimension one is, these are, people look at these giants as though they're impenetrable, and it's not. It's quite the opposite is true. I think thing two was, like, in both companies, was just luck matters a lot, and people tend to have intuitions, like they're successful because they worked hard, or they're smart, or they're gifted, and, like, you need some foundational level of that. But certainly luck, I think, sets the upper bound of a company. The way I think about it is, luck sets the upper bound of a company, and hustle kind of sets the floor. And so, I think those were 2 things. And then thing 3 was, it did not feel like a meritocracy when you're operating in those heavily regulated industries. Like, there's no question that we should not be fracking. Not that we shouldn't be fracking. We could debate whether we should be fracking, but there's no question that we shouldn't be flaring off enormous amounts of gas and not treating that for, like, a massive environmental liability. And it is. And there's a lot of interests which would have made that really expensive for folks to basically cap not cap the wells, but, like, cap the flare gas capture and actually use them and so it would have changed the economics. And so instead we just set it on fire. yeah, like your listeners should just Google North Dakota from space at night. It looks like New York. It's pretty wild.
So you actually mentioned one thing that I actually always I find really insightful, right? Like to you, any of these incumbents could have essentially, or these large companies could have spent minimal amount of resources and identified, you know, a gaping hole, if you will, of opportunity. But it's funny how it's not always so obvious to everyone else. And perhaps there are people internally in the company that suggested that they enter into these markets where it may have been. But generally speaking, I think, you know, one thing that we found in our conversations, especially with those that started their own companies, is they really do identify things that seem so blatantly obvious to them that they can't understand how others don't see it. I'm just kind of curious, you know, what advice you'd give others to kind of seek out within their own lives or their own opportunities, like, you know, that unique perspective that really, you know, compels someone to kind of start a business or start a company and see things a little bit differently.
Yeah. So I mean, I think two things. The business you end up with will not be the business that you start with, or very rarely is. And so I think a lot of folks like have some intuition that they have like some perfect insight, but really like motion matters way more than insight, you know? And so like getting to work on a V1 of this, like we didn't set out to build large wind farms. It just kind of happened, nor did it set me on this path, then try and do flare or any of these kind of things. And so like there is just there's just a fundamental huge watermark around people who are like willing to actually start and do it, because not that many folks do. Two I think really important parts, and my kind of mental model for this stuff is like I can push a certain amount as a person through like discipline, force of will, those kinds of things. But I also like the problem that we're solving with KOHO, the problem we're solving with the wind energy company. I care about those problems, and so those problems also like pull me. And so I tend, like, my mental model for this stuff is like I need to care about the outcome such that like when, are we allowed to swear on this part? Whatever. When stuff gets hard, that it allows me to keep going, right? Because if I was solving a problem that I wouldn't care about, or somebody else cares about that problem more than I do, then there'll be an advantage over me. I think
That's kind of interesting. I mean, how much do you think passion plays a part in, you know, a company's trajectory?
I think a lot, man. So I think about it from, I think a lot. I think if you think about where the best folks in the world want to work, they want to get paid well to solve problems that they care about, right? And if you don't have both of those things, you're not going to be able to compete for the best folks in the world. And so it matters a lot from a competitive advantage. It matters a lot from your culture, your DNA, like the thing that ultimately gets you out of bed in the morning. It doesn't mean you don't have days that don't suck. Of course, you have days that suck. But I think it's a huge part of the story. And then the other thing that I'd say is what's important in this, at least for me, is like, look, KOHO might work. I've had one business that worked. I've had one that didn't. Like there's a lot of macro events that go into the success of a company. But the one thing that I can control is just whether or not I care about the problem that I'm solving. And like, so whatever the outcome is, my hedge on my time is that like, no matter what, I'll feel like my effort was at least directed in the right way. Right. Like it's, and I can feel good about that. And if we go and continue to scale, that's great. And if we don't, but you know, it's hard enough to do this stuff. Even if you don't care, like, especially if you don't care about the problem, you know what I mean?
Yeah, I couldn't agree more. So Dan, we're about at time. So I want to turn over to you, see if you have any closing remarks or anything else that you wish that we talked about that we didn't get a chance to.
I don't think so, man. This was a fun little rapid fire cruise through KOHO and kind of how we think about the market. I don't think so. No, this
any
was fun.
Any website you want to just plug while we have everyone on? You know, again, you are currently, as I understand, only available in Canada. I'm sure there's some plans for international expansion at some point.
Yeah, we're probably a couple years away. We're pretty focused on Canada, at least for we think we're the market leader here, and so we think we're gonna spend the next 2 or 3 years really locking up the market. So I mean, check out KOHO.ca. There's lots of great companies doing what we're doing in the United States that are operating at scale, whether that's Chime or Square, so check those out if those are interesting for you or the clients that you work with.
Yeah, great. Thank you so much. And to everyone else, thank you so much for joining us today. To listen to other episodes of The Yield, please visit and subscribe on Apple Podcasts, YouTube, and Spotify. For any questions on Yield Street, please visit www.yieldstreet.com or email us at investments@yieldstreet.com. Thanks so much.